Okay, today we're going to look at trading comps as a way to value a company. And I built a quick spreadsheet to kind of show you how that works, and let's dive straight in. So here you can see the whole spreadsheet, but I'm going to zoom in so you can see a little bit more as we go. But basically, trading comps or trading comparables look at the valuations of public companies as a multiple of their revenue or their EBITDA or whatever other metric. And have an implied multiple or valuation for that company based on those metrics that you then apply to another company. But let's dig in so you can kind of see. So I've laid out five fictitious public companies. Obviously, if you're a public company, you have a stock price that changes on a daily basis when the markets are open. So I've put the stock prices here. If you're using something like FactSet or another tool that pulls in automatically, you can pull in those prices and update them automatically whenever you open the spreadsheet. But here, I've just hard coded it. You can grab obviously the information from something like Yahoo Finance or Google Finance or whatever it might be. To calculate market cap, that's the equity value of a business. It's basically the share price times the number of shares that are outstanding. And you can get the number of shares outstanding from the, at least in North America, from the public filings. So you can, so literally here on public company one, it's $1.25 a share, 100 shares are outstanding. So it's 125 times 100 basically to get you a $125 million market cap. And so I've done that same calculation for all the companies. Then to get from there, when you're doing revenue multiples and EBITDA multiples, it's based off of an enterprise value. An enterprise value is the market cap or equity value plus net debt. And net debt is debt minus cash. And so here, basically what we've done is hard coded the debt numbers again from you can grab this from the public filings, hard coded the cash numbers, you can grab that from the public filings as well, and then simply deducted the cash from the debt to come up with net debt. And the reason we do this is because that cash could be used to reduce the debt. You could reduce the 3 million of cash in this example to zero and have $3 million less of debt to bring it down to 22 million. So that's why we use net debt as the way from getting from equity value to enterprise value. So then simply enterprise value, as I've said, is the market cap or equity value plus the net debt. And we've done that same formula here for each of these public companies. So that's how we get to enterprise value. Well, then we got to look at that relative to things like revenue and EBITDA, which we've done here. So, here I've just laid out, typically when we're looking at trading comps, we look at multiple years. So we might have an actual like 2023, which is a actual. You could have last 12 months if it's publicly disclosed, and then you would have some forward projections. So estimates from research analysts that use to come up with numbers for the future. So again, I've just punched in random numbers here to kind of show a bit of a trend. And you know, basically looking at 3 years is quite sufficient, I would say. Like you don't have to look at more than 3 years, and any more than a couple of years out, it starts to become very hazy as to what those forecasts are and how accurate they are, obviously. So, there's revenue. Same thing for EBITDA, all hard coded, all labeled here in blue, so that you can see that it's a hard code. And then we just do the simple math of calculating those multiples. So it's basically enterprise value divided by the year's revenue for here. So you can see how that goes across. And you can see again for 2024, it just basically just moves the number over from row R, from column R to column S. And you can see that we've calculated all those multiples. And this is the same calculation pretty much across the board, obviously. So for EBITDA, enterprise value divided by the 2023 EBITDA, or enterprise value divided by the 2024 EBITDA to come up with multiples here. And then here at the bottom, all we've done is taken an average of those and we've taken a median of those. And so you can see how those numbers, on average, they're about, call it 2.5 times revenue as a multiple, or 12 to 13 times as a multiple of EBITDA. And so that's the numbers we're going to use to apply to the company that we're trying to value. So in this case, we've got a company, here that has revenue of 10.2 million in 2023, is projected to have 11.8 million in 2024 and 13.5 million in 2025. Same thing with the EBITDA, where we did 3 million of EBITDA last year, and we're projected to do 3.5 and then 4. So you can kind of see that you basically punch in what you've done for a historical period and what you expect to do for those future periods. And then it's as simple as taking the multiples from above and applying them to those numbers. So you can see here for the implied revenue of $25.1 million based on the 2023 numbers, I took the 10.2 million of revenue and multiplied it by the average multiple for that period of 2.5 to come up with 25.1, and then did the same thing on the EBITDA side of things. Took 3 million of EBITDA and multiplied it by the average multiple. Now, there's a lot of debate, a lot of times, whether you should do the mean or the median. A lot of times investment bankers will cherry pick for the answer that they want, and be consistent though across, okay, if we use a mean for one methodology, then we got to use a mean for another, or use a median, then we have to use median for everything. So so being consistent is kind of important, or it can imply a bit of a range. So what you could do here is say, okay, based on 2023 EBITDA multiples, we've got a range of a value for this business of between 41 and 44 million. And then you do the same math for every period across. It's very easy to obviously extrapolate across multiple years, and you come up with multiple ranges of value. And you could use these data points. Now, a lot of the time, you might, depend on how far into 2024 is and how good you feel about your forecasts, you might use some combination of these numbers basically between 2023 and 2024. You might use a revenue multiple if it's more applicable, or an EBITDA multiple. Really depends on the industry and the maturity of the business and that sort of stuff. Using multiples further out, I would say I would usually caution against. So as you start doing a 2025 implied valuation multiple, it's a little bit harder to do, because there's a little bit more scrutiny around, like, well, how are you going to grow the revenue from 10.2 in 2023 to 13.5 in 2025? So I would just, a word of caution there if you're looking to do longer dated valuations off of forecasts, more than 1 year out. But hopefully this gives you a good idea of how public trading comps work. And if you've got any questions, leave them in the comments below.